Thank you. Thank you all for your testimony. We'll now proceed to the question and answer session. Mr. Rutledge, retirement plan assets are invested to maximize retirement security, not just because it's a good idea, but because it's the law. Why is it important that retirement plan trustees manage funds for the exclusive benefit of American savers and not for ESG or other non-financial goals?
Well, the importance is, over the course of a working person's career, you've got the contributions a person makes, the deferrals a person makes, but the assets are in a trust for the person's working career, and it's the interest earned, the investment return earned on that account that makes up a very substantial portion of the amount of money they have when they finally do reach retirement age. The focus needs to be, and has been, I believe, on maximizing investment performance. Regardless of the label of the fund, regardless of the what you might call a particular fund, a good investment professional advising a fiduciary should be able to, and we trust them to be able to, direct them to the best performing investment, the investment with the best potential for return. That's the way you maximize retirement, and that's the way the subsidies that the Congress has granted the private sector for these plans is validated.
So tax advantage retirement savings represent some of the most significant provisions in the tax code, and tens of millions of Americans rely on them to build their nest egg. How would this system be threatened if retirement plan managers put ESG considerations above financial considerations?
Let me put it this way. Regardless of whether it's an ESG fund, regardless of whether it's an EIT idea, economically targeted investment, you still have to look at the investment and determine whether it's the one with the greatest potential for return. It's possible that an ESG investment in a given situation might represent the best opportunity for gain in that situation at that time and place. And if that's the case, the rules have always been, the guidance has always been, you go with that investment. But the point is that this is a principles-based rule. It's not a rule that says you do this or you choose that investment or you don't choose that investment. The principle is maximizing return given the appropriate amount of risk that a plan is willing to endure.
Thank you. Mr. Isaac, as I noted in my opening remarks, a report on ESG investing produced by the Committee to Unleash Prosperity cites a review published by Boston College in 2020 that found, quote, pension funds with an ESG orientation lag those of non-ESG funds by 2 basis points per year over a 10-year period. In your estimation, what sort of returns are investors seeing from ESG labeled funds, and does this performance indicate that the ESG agenda is aligned with maximizing retirement security?
ESG is certainly not aligned with maximizing retirement security or fiduciary principles. These funds have higher fees, they have lower returns. Virtue signaling is proving very expensive to retirees here in this country, to the detriment of our national security, to the detriment of our fiscal responsibility, and really to the detriment of fiduciary responsibility, fiduciary duty.
So going to the fees that you mentioned, that savers must pay to certain fund managers, how do the Wall Street management fees associated with ESG funds compare to the fees for typical market index funds?
They're typically higher, and there's been research and studies that have been published on this that show that, again, virtue signaling is expensive, and so they charge more money just to have a fund labeled ESG, which is interesting to note that you look at some of these ESG funds, some of them contain companies like the China Coal Company that has higher ESG ratings than American companies that just own real estate, that just own assets, maybe that are going to be produced, or you'll have oil and gas produced on them. But these funds have, again, China Coal Company is in an ESG fund that has a higher rating than American real estate companies.
Wow. How are Americans' long-term retirement savings affected by these ESG management fees, which only line the pockets of Wall Street?
Well, you can see just over the last 10 years, they've given up essentially. They could have had 11.5% return, but they've only had a 4.5% return. That's not keeping pace with inflation.
So, Mr. Bolle, as you know, we held a successful field hearing back in March across the state from you in Yukon, Oklahoma. There we heard how the Biden economy has harmed hardworking families, farmers, oil and gas producers in your state. How do those same folks feel the impact of ESG activism?
Thank you for the question, Chairman. Across the state of Oklahoma, we appreciate you guys coming and to see actually what was going on the home front. That was very refreshing for the people on Main Street. Our people, the Main Street, the small towns and small communities, small businesses, we're not pro or anti. I did a quick straw poll before I left and asked about local businesses' thoughts on ESG, and most of the time I had to explain it. But after I explained it, they said, we want the freedom to choose those things. We do not need a ESG mandate for anything on Main Street.
So what hurdles does the ESG agenda create for your bank and its goals of helping small businesses and building the community?
Again, Congressman, I would go back to any mandates that are put on small businesses or small banks that we have to implement create a significant financial burden for us. Additional regulations, mandates are tough for us to implement.
Thank you. I now recognize